Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. Today we are going to talk about fix and flip investing, and today's guest is Cory Nemoto. He's the co-owner and founder of KÉCŌ Capital. He began his real estate investing career in 2011 in Southern California. Cory has been involved in multiple investment deals ranging from relocation, renovation, and new home development projects. So I am looking forward to learning from Cory today. Welcome, Cory.
Thank you so much for having me on.
Absolutely, it's my pleasure. So, Cory, I hope I did justice to your bio, and I want to remind people that Cory has worked with the beardy Brandon Turner from Bigger Pockets as well.
Yeah. Brandon and David's friends of ours, and I love those guys. You know, as much influence as they have, like they're so down to earth, just great people.
I agree.
Yeah.
So, tell us something interesting or funny about yourself.
Interesting or funny? I don't think there's much funny, but a lot of interesting is my life. I think as a whole is pretty interesting. I never thought it would be, um, I guess, as crazy as it is now. But I currently own and have ownership in multiple companies, all kind of within the real estate realm.
Nice.
So we flip houses, we do ground up construction in Hawaii, Seattle, and we had a project in Vegas, which we just sold this past year. So I'm kind of across the board. We vertically integrated our companies. So we have ownership of real estate brokerage in Seattle, construction company, property management company, and of course our fund. So my day to day, I manage all the Hawaii projects and our investment fund, our hard money fund, KÉCŌ Capital.
Nice. So, why did you start investing in real estate?
That's a good question. What really kind of sparked my interest was reading Rich Dad Poor Dad.
Right.
It changed my life.
A lot of us did, right?
Yeah. It just made so much sense to me, and I was kind of on the path of being a career student. It's like it took me like 7 years to get my degree, and every year that went by, I felt more and more anxious. Like, I don't know if this is really what I want to do. Spend thousands of dollars and years of my life to get a degree in a field that I'm like I can't see myself doing forever. So I was getting a little concerned as it was getting to my final year in college. And then I finally read Rich Dad Poor Dad. And after that, I got linked up with the local investment club in Riverside, California, and kind of started door knocking for a couple of mentors of mine when I was first starting out. And that's where I kind of really got my start. And the strategy that they were using was very interesting. To this day, I haven't seen any other investors utilizing this strategy. And partly it's because the market doesn't favor the strategy. It's kind of, they were flipping notes, basically.
Oh, okay.
So back in 2012, when I kind of started door knocking for them, the market was still recovering in Southern California from the Great Recession. And there was a lot of people upside down with jumbo non-conforming loans on the properties. So banks wanted to basically liquidate those notes because they're high risk. And so these investors would go and negotiate with the homeowner's bank to buy the note at a deep discount. And then they would have the homeowner go and refinance the loan from the investor. So for instance, if the property was worth or if they owed 1.2 million and the property was worth 1 million. So they're upside down,
Right.
200,000. The My mentors would go and negotiate with the homeowner's bank, whoever's holding the note, and negotiate it to buy it at a deep discount, like maybe 800,000.
Wow.
And then they would have the homeowner go and refinance at like 900,000.
Got it.
So the
So
homeowner
basically
wins.
flipping and you don't even have to take care of the property.
Exactly right.
Right.
So the homeowner wins because they're no longer
Right.
upside down.
Yeah.
They owe 900,000 instead of 1.2 on a property that's only valued at $1 million. And then the banks, they got to get what they wanted because they got to liquidate, a high
Right.
risk asset off their books. And the reason why is because usually the banks sell the notes to like Fannie Mae. They sell it
Yes.
on the secondary marketplace to like big institutions like Fannie Mae. But um, when it's a non-conforming loan, they can't sell it to Fannie Mae. That's why they have to keep it
Right.
in their own portfolio, which during that time, banks wanted the cash instead of these high risk loans. So that's where the investor came in, and the investor got to make like 100 grand roughly, right, on the
Right.
deal.
Right. Oh,
So
that's interesting.
so everybody won, and that really showed me the power of real estate, and that investing in real estate isn't just buy and rent, and you're a landlord. There's multiple different
Yeah.
paths to wealth creation.
Hey, so can you talk about your own first real estate deal?
Sure. My actual first deal was a wholesale deal
Oh,
that
okay.
I did. Yep, I did. It was an off-market deal, and it was structured as a subject to deal. So one of my friends, he's a good friend now, and he's a mentor of mine. Like he was my buyer, so I wholesaled it to him. His name's Jonah, and I asked if I could tag along with him to see the project and the
Right.
process through while he flipped the house.
Okay.
And so I wholesaled him the deal, made about 15,000, and got to do the project with him, and he made really good money on that deal, like um, over 150,000 on that one
Nice.
house flip.
Nice.
And so, and I got to learn, right
Right.
alongside him. And to this day, like he's one of the guys I call if I'm about to do something that I think might be a little risky or anything. Like
Right.
there's a few people I call, and Jonah's definitely one of them. And he's taught me about ground up development and how to take raw land and actually build houses there and roads and infrastructure. So I owe a lot to Jonah and a lot of mentors that I kind of linked up with on my way, through my own journey.
That's awesome. So can you define fix and flip investing for us? Because I thought flip means, you buy the house and, you renovate it and then sell it. So what do you mean by fix and flip investing?
Well, fix and flip investing is exactly what you said. We buy, fix, sell. But flipping properties or flipping in real estate, um, you could be flipping contracts. You could be
Oh,
a
okay.
wholesaler, right? So even though you're not really actually flipping the house, you're selling the contract. Your job is to find deals and find buyers, and give your buyers or your clients great deals so that they keep coming back to you. And
Right.
if you can master that, if you can master the first phase of this, which is acquisition, if you can master acquisitions, which cont- contains like I guess finding and funding deals. If you can find deals and fund deals, you can be very wealthy in this industry, right? Because
Right.
that's the two main things. That's like the genesis of wealth creation is finding deals and funding deals.
Got it. So, and when you are investing in a fix flip, do you personally buy the property and then flip it, or you are just acting as a private money lender to another flipper?
Um, well, it's actually kind of both, like
Okay.
now today. So we still buy ourselves. We buy, fix, and sell. More recently, I have right now 11 houses in Hawaii that's going up, where we bought it just dirt, and we're building houses. So,
Oh, okay.
but that's still, to me, in my eyes, considered like an equity play. So,
Right.
short term, it's not passive income for sure, because Hawaii is not a cash flow market. Just like the Bay Area it's
Right.
not a cash flow market, because it's just
It's
a high
always
dollar.
negative. You're going
Right.
money
Yeah.
from your pocket.
Right. So like basically the rents, the market rents, don't they're not comparable to the price tag of getting into a property, so like the numbers just rarely ever work out. Doesn't mean that you can't find great cash flow properties in both of our markets, right? The Bay
Right.
Area and Hawaii. But it's likely you'll get a much higher return in other markets, and hopefully it's emerging markets where
Right.
you're catching it on the way up, right, in that
Yep.
area.
Yep.
So you ride appreciation as well as cash flow and everything after that comes with that, tax savings.
Yep.
So
Yeah, and I call those markets as hybrid markets, right? It gives you both, like how Dallas and Austin were, not anymore, but they
mhm.
used to give you, cash flow plus appreciation. And then there are some markets in Midwest and Southeast where you just get cash flow, barely any
Exactly.
appreciation. So,
Right.
what's your investment criteria when you are looking at flipping a property?
So our investment criteria is we look at two metrics, and that's the net profit and the ROI.
Okay.
So we try to basically only do deals that's going to net us $100,000, so six figures at the end of the project. In Hawaii, it's very doable because since it is high
Right.
dollar,
Yeah,
you
same
know,
California.
right? It's expensive, but you can also make a lot because it's expensive, right? If you can get a really solid deal, typically you have thicker margins. So for us, we look at how much are we going to make dollar wise, and then what is the return that we're getting, because we want to make sure that every dollar that we put out, we know how much dollars
Right.
that dollar is going to bring back. um, so we're making the best use of our capital. And for us, we want to make like a minimum of 30 to 35% ROI on our private capital. So the way we stack our financing when we flip houses, because like we control millions of dollars of real estate in multiple markets without any of our money in. We have some money in, but most of it is other people's money, and we stack hard money financing as the primary debt, and then we bring in gap funding, so private
Okay.
lenders to fill the gap.
Right.
And what we base our ROI on, how much money are we getting in return of our private capital, our gap funding. Because hard money, like once you get qualified and build a great relationship with them, they have unlimited capital
Right.
up to a certain LTV,
Yeah.
right? So
Yeah, of course.
you still have to put some skin in the game, whether it's your capital or private
Right.
investor, right?
Right.
So we look at the ROI based on our private capital, because that's what's really being tied up, and that's what's, for most people, the scarce, I guess, resource in our industry is private capital. So just because, like, let's say we have to tie up $1 million and we're gonna net 100 grand, would we do that deal? I mean, it's a six-figure deal, right? But with that $1 million, we could have done maybe three deals and made 300,000,
Right.
the same amount of money, right? So we probably wouldn't do that deal if we're going to tie up $1 million and net 100 grand. Because so even though it met one of our metrics, which is a
Yeah, but
six-figure deal,
ROI.
the ROI is like 10%, right?
Right.
Basically, my investors get paid more than I do, and I'm doing all the work and taking all the risk,
Yeah.
So yeah, that's the way we look at deals.
Got it. Hey, and what kind of terms are you getting from your hard money lender for these deals?
For standard fix and flip, I mean, we'll get up to 90% of the purchase price and 100% of the renovation budget.
That's
Um,
awesome.
yeah, so it was harder as after COVID.
Yeah.
But for experienced investors who have done like 5 deals or more in the last 3 to 5 years, you can hit the higher leverages, like 90% of the purchase, 100% of the renovation budget. Yeah, interest was like about 9%, 2 points
Okay.
before COVID. Now it's roughly about, I'd say anywhere from 10 to 12%, 2 to 3 points.
Oh wow. Okay.
Gotten more expensive.
Right.
The has gone down, but overall it's still doable. If you got a good deal, it's hard money is still a viable option.
Right. Okay. And let's say if you are investing in a fix and flip deal as private money lender, what kind of returns you would expect?
As a private money lender, I'd probably expect 10 to 12%
Okay.
interest return, APR, simple interest. If if I'm putting up like majority or all of the gap funding, then I may, ask for some equity or ask for some sort of debt and equity structure. But for the most part, 10 to 12% APR, I'd expect.
And the reason I asked is that we are starting to a build of brand new construction single family houses in Tehachapi market, which is close to Bakersfield, and we are looking for private money lenders. And so, of course, we are offering same thing, 11 to 12%. So I just wanted to make sure and understand how it works on your side of the world.
Right. Yeah. It sounds very similar.
Okay.
Yeah. The going
Okay.
rate.
Okay. Which makes sense. So, another question I have about fix and flip is, should someone start fixing and flipping in their own backyard before venturing out?
I would suggest that.
Okay.
I wish I could confidently say, no, you can do this anywhere, and
Right.
you can do this from your computer and stuff. And
Yeah.
that is the case. I mean, like with today's new world,
Yes.
I know many people who do that. They renovate properties and they refi out later to hold it long term, and they've never even seen the property or step foot in the property,
Right.
which to me is amazing. But at the same time, I'm thinking like we kind of do the same thing too. We flip houses in multiple markets, and
Right.
but we also have crew on the ground. We have boots on the
Yes.
ground, people that we trust, and we've been back and forth from these markets constantly.
Right.
So we're always there. Well, before COVID, I was
Right.
traveling a lot, so. But I would recommend, yes, try to look in your backyard, and just it's good practice for fundamentals anyways, is understanding what type of market you're in first of all, and then what cycle is your market in, because even with everything that's going down with the economy and the housing market, um, just because your certain markets like Hawaii is booming and it's white hot, it doesn't mean that every single market across the nation
You're
is
right.
the same, right? So like for Hawaii, we were notoriously low in inventory. Um, so that's always the reason why the cost of living and the price for the median single family house keeps going up, but
Right.
especially now when inventory is extra low, basically, a big chunk of foreclosure inventory hasn't hit the market yet. And, earlier people were afraid to put their houses on market during COVID because they're thinking, oh, we can't have
Right.
open house.
Yeah,
So
exactly.
I don't want people walking through my house while so there was a huge shortage of inventory. And I was thinking, okay, once we do start opening back up and having open houses and putting everyone's now all this backed up inventory getting ready to hit the market, I was thinking, well, when that happens, that's going to be the first test to see what happens to the market, And the inventory came out, and basically it didn't slow
Nothing.
down.
Yeah.
So, and it's the low interest rates as well. So
Right. Right.
it's just the perfect storm for this
It's the
market that
free
we're.
money, right? So yeah, it's the same issue with Bay Area as well. It's all about supply and demand, and I agree. The inventory itself, because I also saw that if the seller did not need to sell, why would they even try to sell the house, right? Why do we want to move out during COVID, right? In the middle of COVID.
Right.
So last year in 2020, I was looking at, and the inventories were between 40 to 70% lower than year before, right? So that's huge.
Yeah.
Because of course that's gonna, well, increase the pricing, right? Because the demand is still there.
Yep.
So, and I always talk about the real estate cycle as well, as you mentioned, that real estate is something where even if the market corrects, not all of the markets in US will go down together. It is not similar to stock market, and I keep mentioning this again and again, that if Brexit happens, not the entire world stock market, how it went down, that's not how real estate would react. Because if the markets in California or Arizona, when they went down, even Dallas and other parts of the country were still doing good, right? So
Right.
yeah, that's how the cycles work.
Yeah. Yeah, absolutely. So understanding, your local market, and then and then looking at what strategy best fits your current situation, and what strategy best fits your current market that you're living in, and then start right there. And for me, I had nothing when I started. I had no money, no connections, and actually like no knowledge either. I kind of just picked up and went and stumbled a lot along the way, but I wasn't afraid to ask questions, and I was very I'm an introvert, and when I would go to like conferences or any type of seminar or free training, like I would be the guy in the back row closest to the exit that never raised his hand, never asked a question, but I was there, I was present, and I was taking notes, and I would write down words that I didn't understand at the time and go home and Google it and try to piece everything together.
Yeah,
So
yeah, that's
that's
how
the
it
guy who
works.
I was. And but I was still learning in my own way, in which way that made me comfortable. And might have took me a little longer maybe because I was a little I guess shamed to ask questions when
Right.
looking back, I shouldn't have. But um I think everyone's on their own journey, right? Their own path, and
Yeah.
there's no one way. There's people have left roadmaps before us, who've come through and built a lot of wealth through real estate and helped a lot of people and made a huge impact. So the roadmap is there, but the journey will be different for everybody.
Got it. So, this may be a curveball, but I want to understand, because I always thought fix and flip means you end up paying a lot of taxes.
Mhm.
So, how does taxes work in fix and flip, right? How do you circumvent? Is there a way to circumvent? Because if you keep the property for less than a year, of course you are hit with the short-term capital gains, right?
Right. Well, to be honest, like I never really I never really worried about that, about taxes, because short-term capital gains is what it is. You got to pay it, and uh, I f- I feel like when you're going into anything like fix and flip or ground up construction or wholesaling, you got to think of it as kind of what it is. It's active
Right.
income,
It
you
is
know.
active. Yep.
Yeah. So the point when we flip houses and if we if we wholesale or do ground up construction and development, it's it's just a short term play. You
Yep.
know, we're not going to be house flipping forever. Even though it fulfills me and I take a lot of, we make a huge impact. Like a lot of people benefit from us taking on the risk of doing a project, from
Right.
realtors and escrow agents and even termite inspectors and photographers and
Yeah.
stagers,
Yeah. Everyone, and of course the buyer.
Yeah, the buyer, of course, our private lenders, they have a great investment vehicle through us. Our contractors get jobs. So we make a huge impact, and that's why it's very fulfilling. But it's never going to be our forever thing, because it's
Right.
just it's just another tool to get us to the end goal, which is wealth creation and passive, um, passive income and passive financial freedom. So
Right.
we we do a lot of equity deals like fix and flip in Hawaii and Seattle, but all that money and any of those profits go back to our companies, or it goes back into investing in passive income,
Got it.
whether it's rentals or lending, you
And
know, lending it out to other investors. That's the roadmap for
that's
us.
exactly where I was going. So, uh, how do your passive investors or the private money lenders get paid? Do they get like interest income, and are they able to use that interest income as a passive income? Because if they had a passive loss from another syndication, do you know how that works?
Yeah, so at least for our lenders, it's a little different than like investing in a syndication as
Right.
an LP or something like that. Um, they because it's more of a debt. It's a
Yes.
debt
Yeah, you are a
position.
lender. Yep.
So um, they they get a promised rate of return, they get a promissory note, they get a mortgage. So we give them, as the borrower, we'll give them a promissory note and a mortgage in exchange for their investment.
Right.
Um, so the promissory note and the mortgage will secure our investors' capital and their investment against the property, right? So the property is their collateral. And then we also get, we always get property insurance and title insurance,
Right.
which secures the asset to which the money is collateralized on. You know what I mean? So we for the most part, private lending, you know, is a powerful way to build your wealth passively. And I always say, like, when you're raising capital, it should never feel like you are selling somebody. The moment you feel like you're trying to sell someone to invest in you, I think you're doing it wrong, you know?
Right.
And because it shouldn't be about selling somebody uh, investing with you. It should be about educating them, because when you think about the fundamentals of investing, whether it be in real estate or Bitcoin or whatever, it always comes down to what's my risk and what's my return,
Yeah.
and is the return worth the risk, right?
Yes.
That's what it comes down to. So when I teach other people, like, like how to raise private capital, it should be easy, it should be genuine, because if you think about it, what we offer our investors, it basically beats out the majority of investment vehicles out there right now. So we offer, let's say, 12% return interest, right?
Right.
So that is exponentially higher than the average day investment vehicles out there, like a 401k, a mutual fund, or whatever. So when it comes to what's my return, well, we offer exponentially higher rate of return than most investment vehicles out there. Now, when it comes to, okay, well, what's my risk though, right? And well, you always have risk in any venture that you go into, whether it's investing in real estate or anything else. Of course, there's risk. Nothing is 100% certain, but investing in real estate as a private lender can be a lot more secure than maybe putting your money in with a brokerage that's managing your retirement, and taking fees. Because I mean, if the market crashes, if the stock market crashes and your money's all in there, you kind of just gotta hope and pray it comes
Right.
back,
Right.
or gotta sell and cut your losses. There is no collateral, is what I'm
Right.
saying.
Yep.
you
Yep.
know
I
so
agree.
now, what's the likelihood of that happening? Maybe once every 10 years or so, or every cycle, every major cycle.
Right.
But you don't want to be caught in the down. So a lot of people got wiped out in 2008,
Yes.
2009. So um but a lot of people got wiped out in real estate too, right? So
Yes. Yeah. When you
there
are over leveraged, right, and you don't have a
exactly.
plan.
Yes, yeah. So in real estate though, you do have collateral in a tangible asset,
Yes.
right?
Yes. It's a real
And
asset.
exactly. And so Is it more secure? It is more secure than most investment vehicles out there because you get collateral in a tangible asset. And the other thing is, all of my investors know me. They know where I live. They
Yeah.
have my direct number. Whereas, let's say you invest in, SpaceX or
Yeah.
Tesla,
I
and
don't know where Mark Zuckerberg lives.
right.
Or where
I don't
Elon
know where
Musk
this Bezos guy is.
is.
Like what is he
Right.
doing with his, what's the plans
Right.
for,
Right.
and usually in the
Exactly.
stock market as a retail investor, we're the last to know,
Yeah.
so like, I like the odds being stacked in our favor, right? Just as like when I'm done and my plan is just to, I'll have some cash flow properties for sure, but I'm just going to lend. I'm going to live off the interest. That's
Right.
ultimate passive
Right.
income,
And
so
the other thing to mention when you're comparing stocks, right? Because here you are able to invest in the person as well as the deal, right? In Facebook or Apple, I cannot say, oh, I only want to invest in iPod or iPhones, right? You are
right.
investing in the entire business, and they may mess up that product or a new deal, right? Uh, so, but here you are basically literally analyzing that particular deal at that point of time, right? So you have a lot more control over where your money goes.
Exactly. Exactly.
This was awesome. So let's take a quick break, Corey, and after the break, we'll go through the fire round.
Awesome.
You're listening to the Wealth Matters Podcast.
The Wealth Matters Podcast.
For more info about what we do, check us out at wealthmatters.com. It's wealth, WEALTH, matters, MATRS.com.
Welcome back to Wealth Matters Podcast. I have Cory Nemoto with me. Cory, are you ready for fire round?
I am ready.
Okay, would you be changing any business or investment strategy after coronavirus is over?
Yes, we have. And it's not really anything. It's kind of like for coronavirus, and two is I'm going to be focusing more on building out our fund so that we can help finance other investors and give them the capital. We have a lot of big plans, for this new company. So after COVID, especially since I think the market will still hold strong for, until they start to talk about increasing interest rates.
Right.
So in the meantime, I'm focused on selling the rest of my projects, and then I'm going to take a little break. I know the team wants a little break too, and we're going to focus on building out our fund, but we'll be back.
Absolutely. Favorite real estate or finance or maybe a personal development book?
Ooh, okay. Favorite real estate book. I like I guess Jay Scott's book. I don't know if you read it.
Rehab.
Yeah, and partly because I think I loved it. It's been a while since I read it, but it was a lot of tangible content for me when I was first starting out. So I that's one of my favorite books about real estate. And favorite, I guess, non-real estate book, it would have to be The Go Giver for sure.
Oh man. Okay. You got me there. That's my favorite book. I even had Bob Berg on my podcast last year.
Oh
Yeah,
wow.
yeah. He's awesome, and I love that book.
Oh
Someone gave it to me like I would say 3 years ago, and I just fell, or a couple of years ago, I fell in love with that book, and it's so small, so powerful. Yeah,
yep.
I cannot agree anymore. It's a great book, man.
Yeah.
Any tool or website you recommend or you cannot live without in your particular business?
Man, these are great questions. So I guess for me, there's a site called tomatotimer.com.
Tomato timer, huh?
It's just tomato hyphen timer. All it is like a 20, it's like a countdown clock,
Okay.
and because it's based off the Pomodoro method, which is like you work for 25 minutes, undistracted, on one task.
Yeah.
And when you hit 25 minutes, you take like a 5-minute break,
Right.
and then you go back. So I haven't gotten to the point where I'm consistent and very disciplined on time blocking and that, but right now, like that's one of my go-to sites. Just put that thing up, hit the start button and get going.
Okay, I'm gonna start using it too. That's one of the problem I'm facing, and I think that's the problem every entrepreneur or real estate investor who is trying to scale up will face, right? Because it's either distraction, procrastination, or something else just comes
Right.
up, right? So I'm gonna start using that too. And this is an important question, actually. Any advice for beginner investors?
For beginner investors, um, the best advice I can give is first look inward, like find out what value you have to give. Um, and everybody has value, whether it's your time and sweat equity, maybe you do have money and you're willing to pay to play, willing to find out who's a trustworthy and experienced investor who's doing what you want to do, and maybe lend some money to that investor and become a partner and learn, or invest your time and your energy in helping that person. But find out what you have to offer, and then I would say go out and find out who are the players in your market that you want to play ball in. Find out who's the players and find out their needs and give them value, whether it's your time, your energy, your money, your contacts. Find a way to bring value to them and learn as much as you can, because the formula is the same to kick down the doors in any market. Honestly, we've done it multiple times, and what you really have to do is find out who the players are. So you have to embed in the market, learn about the market, who's the players there, who's actually doing deals, and find out if that person is someone that fits, your moral compass, your, the way you do business, and bring value to them. Find a way, how can you help them? And if you just focus your energy on finding out who are the players that are making an impact in that market and finding a way to serve them without any expectations of any returns, magic will happen. You will do deals, you will break through in the market faster than anybody else who's trying to be out there by themselves, trying to figure it out by themselves. Like if you find the right partner or mentor, they'll help you cut through the fat real quick. And you'll know what to focus on and what not to focus on. But in order to do that, I'd say you first have to find out what you have to offer and what you're willing to offer someone else, and then go find that someone else and give it to them. Like it's not tangible real estate advice, like, go pull this list, use this marketing piece. No, it's not that advice, but it is worth more. I can tell you that.
Oh, that's
Like the
awesome.
intangible is so much more powerful than the tangible. Don't worry about what list you're going to pull or what marketing piece you're going to pull.
Right.
Worry about what you have to offer, and then worry about who you're going to offer that to.
Yep.
So like that's really how you break through this industry. We've done it multiple times in multiple markets.
Oh, that is awesome. How do you give back?
Well, there's a lot. I mean, more recently, we I've been starting to get comfortable in the role of being a mentor, to others. And I have two interns that are kind of up and coming, young and hungry, and um, I'm helping them. So there's a lot of time that's given there, and it's very fulfilling to me, to be honest. And I'm not in the business to sell coaching programs and stuff like that, but I can see why some people may do that, because it's fulfilling. I mean, and also it's probably a profitable business. I
Right,
don't know
of
the economics
course.
behind that, but I know like for me and myself, like I'd do it for free if I had all the time in the world, and so I try to give back by, helping other investors on their way up, and we also have foundations that we donate to, like the Mercy Housing Foundation, and because like giving back is very important as well,
Yep,
right?
it is very important.
Mhm.
So, how can my listeners reach out to you?
I like social media just directly to my personal accounts because then I can interact with everybody and we can kind of get straight to it. They can see what we're all about because I kind of post as much as I can like the stuff that we do and we do some fun stuff. But they can catch me on Facebook or Instagram. My handle is just at Cory.Nemoto on both Facebook and Instagram. So feel free to reach out. If you guys need anything, just let me know, and I'll do my best to help you guys or anyone else.
Hey, Cory, this was so amazing, man. I learned a lot. Thank you so much.
No, thank you, brother, and I really appreciate your time and bringing me on. It's always a
Absolutely.
blast.
Have a great weekend.
You too.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!